All right, ready to dive deep into Berkshire Hathaway's 2020 performance? We've got Warren Buffett's famous shareholder letter as our guide, kind of like a treasure map to his investing secrets. Plus, we've got some thought-provoking discussion points to unearth the real gems.
It's really something how Buffett can make financial statements read like a captivating story. He weaves together the numbers, business philosophy, even a touch of Americana. It's a good reminder that investing, it isn't just about the numbers. You got to understand the people, the companies behind them.
Absolutely. And speaking of numbers, Berkshire raked in a cool $42.5 billion in 2020. But there's a catch. That figure includes some big investment gains. When you focus on operating earnings, which is what Buffett really considers the core of a business's true earning power, there's a different story, a 9% dip. So what's the deal with that difference? Doesn't it all just add up to the bottom line?
Not quite. See, Buffett's a big believer in this idea of intrinsic value. It's like figuring out what a business is truly worth, based on its ability to generate cash flow over the long term. Operating earnings give us a clearer picture of that long-term potential. Investment gains, on the other hand, they can be a bit like, well, winning the lottery. Exciting, but not always a guarantee of future success.
So it's like judging a bakery based on how good their bread is, not just getting distracted by the fancy new oven they bought. The bread is the consistent product, the core, while the oven is just a shiny tool.
Exactly. Now imagine that bakery also owns a few other fantastic businesses, maybe a coffee shop next door, a booming online baking supply store. That's kind of what we're looking at with Berkshire's Big Four jewels, their most valuable assets.
Okay, tell me more about these jewels. What makes them so special?
Well, first up, we've got their property and casualty insurance operations. They're sitting on this mountain of capital, gives them a huge advantage. Unlike most insurers who are stuck with low-yielding bonds, Berkshire can really go big on stocks.
Smart move, especially with bond yields being so low these days. Didn't Buffett say something about investors practically paying to lend money to some governments?
He did. He pointed out that the yield on a 10-year U.S. Treasury bond, it's dropped a whopping 94% since 1981. Imagine investing $100 back then and getting pennies on the dollar today compared to decades ago. It really doesn't paint a good picture for folks relying just on bonds.
Yeah, that's a great point. It's like putting your money in a time capsule, but when you open it years later, its buying power has shriveled up. Okay, back to those jewels. What else shines bright in Berkshire's crown?
The second and third jewels, they're neck and neck. BNSF Railway, the undisputed king of freight volume in America, and then a big chunk of Apple, a 5.4% stake to be precise.
Apple, the tech giant. That seems a little out of character for a company known for more, traditional investments.
Yeah, it is a bit of a curveball. But it shows Buffett's not afraid to adapt, to move with the times. And here's where it gets really interesting. Apple is a prime example of his love for share buybacks when they're done right. Imagine a company like Apple steadily buying back its own shares. What happens? The ownership pie gets divided into fewer slices, and each slice represents a bigger piece of the whole.
So for those who hang on to their Apple stock, they're essentially getting a bigger and bigger slice of the pie without paying extra. They benefit from the company's growth and these buybacks, even without buying more shares.
Exactly. And then finally, the fourth jewel is a bit of an unsung hero, really. Berkshire Hathaway Energy, or BHE. This 91% owned subsidiary has quietly grown its earnings from a modest $122 million to a whopping $3.4 billion in just 2 decades.
Wow, that's a silent powerhouse. It's incredible. They've got this diverse collection of businesses, almost like a miniature economy all under one roof. But how do they even manage such a huge empire? I mean, it's labeled a conglomerate, which doesn't always have the best reputation. It can seem like a bunch of unrelated companies just thrown together.
That's where Buffett and his partner, Charlie Munger, they come in. They're very deliberate about how they build this conglomerate. It's not just about grabbing any company they can get their hands on.
So what's their secret? What's their approach?
Well, they're obsessed with owning part of great businesses, even if they don't control the whole thing. It's like owning a share of a championship sports team. You benefit from their success without having to call the plays. They focus on companies with solid economics, strong management teams.
So it's about quality over quantity, right? It's better to have a piece of a winner than the entirety of a mediocre player. This makes me think about those Omaha and Knoxville miracles that Buffett talks about in his letter. Those heartwarming stories of businesses that thrived far from Wall Street.
It's a good reminder that amazing companies, they exist everywhere, not just in the big financial centers.
Okay, let's take a virtual road trip to those hometown success stories. What kind of hidden gems did Buffett find?
All right, let's start in Omaha, Berkshire's home turf. Picture this. It's 1940. A local guy named Jack Ringwalt starts a tiny insurance company, just $125,000 to his name.
What a David versus Goliath story. Did this little guy even stand a chance against the giants?
Well, Jack had a different strategy. He focused on insuring unusual risks, the kind the big players wouldn't touch, and guess what? It worked. Buffett was so impressed he bought the company, National Indemnity, back in 1967.
How long did that deal take? Weeks of negotiations?
Nope. Just a 15-minute handshake, no audit needed. Talk about trust and shared vision. Now, for the other Omaha gem, the legendary Nebraska Furniture Mart, or NFM. It all started with a Russian immigrant, Mrs. B, came to the U.S. without speaking any English.
That's an inspiring story. Immigrant to business mogul, what was her secret?
She had this incredible grit, pure determination. By 1936, she saved up $2,500, enough to open her first store. But things really took off after World War II when her son Louis came back from service. Together, they built NFM into one of the largest home furnishing businesses in the whole country.
It's amazing they turned $50 in cash in 1946 into this massive success story. That's the American dream right there.
Oh.
And Mrs. B working until she was 103. Wow, that's dedication. Okay, next stop on our road trip, Knoxville, Tennessee. What treasures did Buffett find there?
2 more billion-dollar businesses, Clayton Homes and Pilot Travel Centers, both founded by University of Tennessee grads who chose to stay in Knoxville, build their empires right there.
You know, it just goes to show success isn't limited to the big cities. There's talent and ambition all over America. It's like a perfect example of the entrepreneurial spirit that drives the whole country.
Absolutely. And here's a fun twist. It was actually Jim Clayton's son, Kevin, who encouraged the Haslam family, the folks behind Pilot, to sell part of their business to Berkshire. It's like a chain of satisfied customers, but instead of a product, it's about finding the perfect long-term home for a business.
So we've seen how much Buffett values strong management, businesses that last. He's not chasing fads, he's building something that endures. But how does this connect to Berkshire's partnership mentality, the one he spends so much time on in his letter?
That's a great question. And that's what we'll pick up after a quick break.
So we were just talking about how much Buffett loves those businesses that really stand the test of time. And it seems like that same philosophy, it extends to his relationship with Berkshire's shareholders. He really emphasizes this unique bond, this partnership mentality. It's like he sees the shareholders as part of the Berkshire family.
Yeah, it's really interesting how he traces this all the way back to when he was managing money for individuals, through those partnerships he had long before Berkshire even existed. Back then, it was all about trust, this shared goal. Avoid those big losses and achieve those steady, reasonable returns over time.
He even talks about serving the hamburgers and Coke crowd, not the fancy cuisine Wall Street types. I love that. It's like he's saying, look, I'm not trying to impress you with some complicated strategy or risky bets. I'm here to help you grow your wealth steadily, safely over the long term.
Exactly. He's not interested in those get-rich-quick schemes or market timing. He's all about building wealth the old-fashioned way, by investing in solid businesses, holding on for the long haul.
And what's amazing is how even today, with Berkshire being this giant public company, he still seems to have that personal touch, that sense of partnership with individual investors.
It really is remarkable. He even breaks down Berkshire's ownership into 5 buckets. One bucket, it's his own ownership, and that one's gradually shrinking as he donates his shares to charity.
And the other buckets?
Well, 2 of them are filled with those institutional investors, the index funds. They hold Berkshire just because they have to. And then there's those active managers, always moving money around. And then we have the individual shareholders who act kind of like those active managers, always buying and selling.
But then there's that 5th bucket, right, the special one.
Yeah. This bucket, it holds, as he puts it, the million-plus individual investors who simply trust us. They're in it for the long game, just like those early partners from way back when. They're not chasing those hot stocks or trying to time the market. They're with Berkshire because they believe in the company, in its long-term vision.
And you can tell that Buffett really feels a deep responsibility to this group. He wants to make sure that as his ownership goes down, those seats at Berkshire, they're filled by people who share his values, that long-term perspective.
He even mentions his friend, Stan Trulson, an ophthalmologist, invested with him back in 1959. Still holds those Berkshire shares, even at 100 years old.
Maybe there's something to that long-term perspective, both in life and investing.
Absolutely. Patience, discipline, they pay off in the end. But let's shift gears for a sec. We've been talking about Buffett's long-term focus, but 2020 threw everyone a curveball, the pandemic. How did Berkshire handle that storm, And did it make Buffett rethink any of his long-held beliefs?
Well, one of the most surprising things Buffett did in 2020 was selling all of Berkshire's airline stock.
Yeah.
Caught a lot of people off guard, seemed to contradict his famous buy and hold philosophy. What was going on there?
Yeah, it definitely raised some eyebrows.
Hmm.
But remember, Buffett's all about adapting to changing circumstances. He's not afraid to admit when he's made a mistake or when his original thesis, it just doesn't hold water anymore.
So with the airlines, he basically decided that the pandemic, it wasn't just a temporary blip in travel, it was a potential game changer for the whole industry.
Exactly. The long-term outlook for air travel, it became much more uncertain. And for Buffett, someone who always puts capital preservation first, the risk of those airlines never fully bouncing back, well, it was just too big.
It's a good reminder that even the most experienced investors, they have to be flexible, willing to adjust their strategies when the world throws a curveball.
It also highlights this key principle of investing, knowing when to cut your losses. Sometimes the best thing to do is walk away from an investment that's no longer serving your goals, even if it means saying, hey, I was wrong.
Yeah, it takes humility to do that, to admit you misjudged something. But Buffett doesn't shy away from it. He acknowledges that he messed up buying those airlines to begin with, and he explains his reasons for selling, clearly and directly.
Transparency, accountability,
Yeah.
they're crucial, especially when you're handling other people's money. I think that's part of what makes Buffett such a respected figure. He doesn't hide his mistakes or act like he knows everything. He's upfront about his wins and his losses.
Of course, we can't ignore the fact that Buffett is 90 years old. His decision to sell those airlines maybe was influenced by his age, perhaps a shorter time horizon.
That's a valid point. But it raises an interesting question for everyone investing, no matter how old they are. Time horizons matter. What might be a reasonable holding period for someone in their 30s or 40s could be very different for someone closer to retirement.
It all goes back to understanding your own investment goals, your risk tolerance, and yeah, that time horizon. No one-size-fits-all approach in investing. What matters is finding what works for you and sticking to those principles.
Now, speaking of adapting to change, let's talk about that famous Berkshire Hathaway shareholder meeting. The pandemic, it forced them to go virtual in 2020, a huge departure from their usual in-person event.
I can't even imagine a virtual Buffett. Can you? All that energy, charisma stuck behind a computer screen?
It was definitely different, but they made it work. And Buffett, the showman that he is, he still made it entertaining. Shared the stage with Greg Abel, one of his vice chairmen, fielded questions from CNBC's Becky Quick.
And of course, they had to have the Berkshire staples, the See's candies, and Coca-Cola. It's not a real Berkshire meeting without them.
Exactly. But even though the virtual thing worked, you could tell that both Buffett and those shareholders, they missed the energy, the excitement of that in-person gathering. He even said he hoped to be back in Omaha in 2022 for a real shareholder meeting, Berkshire style.
Well, looks like they'll be in Los Angeles this year, but at least Charlie Munger's going to be back on stage with him. I bet Buffett missed their witty back and forth as much as the shareholders did.
I'm sure he did. And just to make things more interesting, Ajit Jain and Greg Abel, the other two vice chairmen, they'll be there too, answering questions about their areas.
Sounds like it'll be an event you won't want to miss, even if it's virtual again. So we've covered a lot of ground, haven't we? Financial performance, investment philosophy, those heartwarming stories of entrepreneurship, even that unexpected reveal about Berkshire's asset-heavy nature. And we talked about how Buffett and his team adapted to the pandemic.
And throughout it all, you see this unwavering belief in the power of American business, that long-term view, and a real commitment to those shareholders, treating them like partners, not just investors.
But before we wrap things up completely, I want to go back to something we touched on earlier. Buffett's decision to sell those airline stocks seemed to contradict his belief in holding investments for the long term. How do we reconcile those two things?
That's the million-dollar question, isn't it? And
Yeah.
that's exactly what we're going to explore in the last part of our deep dive. We'll get into the details of Buffett's decision, the factors he considered, and see if we can learn some valuable lessons for our own investment journeys.
Stay tuned, folks. We're about to go even deeper. Okay, welcome back to the last part of our Berkshire Hathaway deep dive. We've gone through Buffett's investment philosophy, explored those amazing success stories, and even found a few surprises along the way.
And now it's time to tackle that big question that's been hanging around. How do we make sense of Buffett selling all his airline stocks in 2020 when he's always preaching about holding investments for the long term?
It did seem like a pretty bold move, almost out of character for the guy who famously said if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Yeah, but notice that word willing. It doesn't mean you have to hold on to a stock no matter what happens. It's more about constantly checking if your reasons for owning it still make sense, and being ready to shift gears if things change drastically.
So in the case of those airlines, the pandemic, it wasn't just a temporary dip in travel. It was like a major earthquake that shook the whole industry, maybe even changed it forever.
Exactly. Buffett realized that the long-term recovery of air travel, it was anything but certain. And remember, his main focus is always protecting the money, not trying to prove a point by being stubborn. In his mind, the potential for losing money for good, it outweighed the chance of a comeback.
It's a good reminder that even the smartest investors in the world can make decisions that don't work out. And sometimes the smartest move is just to cut your losses and move on.
Absolutely. And what I admire is that Buffett doesn't try to sweep his missteps under the rug. He openly admits he messed up buying those airlines in the first place. He misjudged how tough the industry would be when faced with a crisis like that.
It's so refreshing to see that honesty, especially in a world where so many people try to hide their mistakes.
Transparency and accountability, those are key parts of Buffett's leadership style. He doesn't pretend he's got all the answers, and I think that's a big reason why people respect him so much.
It's totally different from that whole never apologize, never explain attitude you see so often. Now, some people might argue that Buffett's decision was partly because of his age. I mean, at 90, maybe he's not as willing to wait years for a recovery that might not even happen.
That's a valid point. But the bigger takeaway here is that time horizons are a huge factor in investing. What might be a reasonable holding period for one person could be totally different for someone else. It all depends on their goals, how much risk they're comfortable with, and yeah, their age too.
So it's not about blindly following a rule like hold for 10 years no matter what. It's about having a solid investment philosophy, really understanding the businesses you're invested in, and being open to changing your approach when the situation demands it.
Exactly. There's no magic formula that works for everyone. It's about finding what fits you best, making sure your decisions line up with your goals, and keeping up with how things are changing.
So what does all this mean for our listeners? What's the main takeaway from our Berkshire Hathaway deep dive?
Well, I hope you've come away with a better understanding of how complex investing really is. It's not just about picking stocks and crossing your fingers. It's about digging into those businesses, figuring out the risks, making decisions that help you reach your long-term goals, and yeah, even being ready to change direction when you need to.
And if there's one big lesson to learn from Warren Buffett, it's this. Always keep learning, never stop trying to learn new things, be ready to adapt, and don't be afraid to admit when you're wrong.
And remember, as Buffett himself might say, never bet against America, but don't be afraid to ditch those airlines when a pandemic hits.
Some wise words to end on. Well, that's a wrap for our Berkshire Hathaway deep dive. We hope you enjoyed the journey and maybe picked up some new insights along the way. Until next time, keep exploring, keep learning, and keep investing in your knowledge.